It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today we're taking a look at investing plays amid macroeconomic uncertainty. I'm here with Washington Crossing Advisors Senior Portfolio Manager Chad Morganlander. He's a frequent guest here on Goodbye or Goodbye, and it's always good to see you, Chad.
Thanks for having me.
So let's get to the stock that you like here. It is Oracle. The stock's up about 20% or so over the past 12 months. It has gotten a big lift from the whole AI enthusiasm, Stargate, et cetera. So let's dig into why you still like it here. You talk about the shift that the business itself has done, not a sort of macro business shift, but a shift that Oracle itself has done.
Originally a database company, becoming a cloud computing company, becoming a cloud AI company, and then adding on to that, data security has been paramount. Oracle is one of the best when it comes to that. So we believe that Oracle should see a revenue lift over the next 5 years of at least 10% year over year.
And also, let's dig into a little bit the AI piece of that and how that's going to play into Oracle, how Oracle is going to be able to benefit from it.
So first, they've had a backlog of orders now over $100 billion from all of the LLM companies out there. But the reality is the bigger revenue opportunity is how do you take corporate America and have this developed into a use case where it's actually being efficient and creating productivity and revenues. And Oracle will be on the leading edge of helping companies convert their data into the LLM models to then generate additional revenue that will be subscription-based. We believe that this potential opportunity is higher margin business than perhaps just training the LLM models.
And then I know the other piece of that is not just helping clients optimize revenue, but also helping them be more productive and cut costs. At least that's the goal of all of this AI stuff.
Right. So apparently they are the cheaper provider of database as well as cloud computing. But overall, what you've noticed is that IT spending across corporate America hasn't gapped higher all that much. So you could see this conversion where companies, corporate America, is moving towards using Oracle or Amazon Cloud Services or Azure Cloud Services. We believe that that trend will continue over the next 3 to 5 years.
We always like to talk about, as you know, what could be the potential risks to this thesis here. Maybe you see an overbuild. I mean, that's sort of the, there's been so much talk about that this year. You've got all these big spending plans on the part of the hyperscalers to try to build out all of this, but it's a crowded market right now. There's a lot of competition. How's that going to play out?
Right, and the concern is that this could play out similar to what happened with the dot-com era when it came to all of the fiber optics. We believe that they are much more careful in building out their network overall. That is a general concern, but we believe that they're not overextending with their capital outlay as of now. But that certainly is a risk, hence the reason why after the DeepSeek news came out, the stock traded off roughly about 15%.
And you do have a position in Oracle, I believe, right?
Yes, the firm does, and so does my family.
Gotcha. Okay, let's get to the stock you don't like as much. That is Capital One. Capital One shares are actually also up 20-ish% or so year to date. Like Oracle, they've come down from the highs with the recent sell-off. And this, you say, is a more economically sensitive name. I mean, big credit card issuer, where are its vulnerabilities?
So similar to your previous guest from Citi, the concern generally is employment trends. If you do have a moderation of employment, then you could see some credit card liability on their balance sheet. Also, the critical thing here is that as the Federal Reserve looks at these type of companies, they may be a little bit, let's just say credit conditions have been very easy.
Gotcha. What about financial conditions, though, that could potentially be changing?
Okay, so credit spreads when it comes to high-yield bonds or investment-grade bonds are pretty much historically at its low. Yes, it's wiggled up a bit, but any kind of normalization of credit spreads would be a major headwind for financials. They are very sensitive to the U.S. economy, to jobs, and most important, to financial conditions.
Right, so they might not be as profitable in that kind of a situation.
Correct.
Here. And then finally, abnormal volatility tied to leverage. Explain to us what you mean there and how that relates to Capital One.
Sure. So at Washington Crossing Advisors, we prefer not to buy companies that have an excessive amount of leverage. And what effectively happens is as you start to see financial stress or credit widening, the stock price starts to act and behave like a stock option. And you could see that it happens in such a violent manner that one should just be mindful that they're looking at a cheap PE ratio, maybe a dividend yield that is quite lucrative. But overall, as you start to see financial stress, the equity price reacts in just such a violent fashion that we would prefer just to kind of shy away from it.
I'm just curious, as an aside, are you elsewhere positioned in the financials, just not in a name like Capital One?
We would shy away from the big banks and the regional banks. We would prefer companies like the Visa or a Broadridge or a Marsh. We believe that that's a better way and a safer way to play it, in particular because financial conditions historically are very loose right now, still.
Interesting. All right, what could go right for Capital One? Well, an improvement of some of these things that you're talking about, financial conditions and credit spreads.
Or the Federal Reserve comes in, drops rates by a tremendous amount, and floods the market with liquidity like they did back in the last 10 years.
And if they have to do that, maybe we should be worried for other reasons, right, Chad?
Exactly right.
I would think so. All right, thank you so much for being here. Really appreciate it. And thank you so much for watching Goodbye or Goodbye. We'll bring you new episodes at 3:30 p.m. Eastern.